Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, answer some questions, thoughts, and obviously share a bunch of opinions and data about commodities, wealth building, and financial topics. I'm going to interject a whole bunch of my opinion, sprinkle in some experience, sprinkle in some things that I have encountered in my own life with some of these questions, and you can see how I dealt with it. Not that I've got the only answer out there, but obviously you can hear what I did and what my opinions are on some of these topics because there are things that I encountered as I went through my life. So I'll answer some of those. And again, if you want to follow me, it's at finding_finance. And if you want to join our community, it's finding-value.com to play this commodity bull market that we are in and what is coming. Those are the individual companies, the sectors, when I'm buying stuff, how I'm trying to time it. I don't think you can time the short term perfectly, but if you can do your best and get good entry points, that is really the name of the game, and implementing some of the strategies that I do. So this guy says, what about this historical chart not adjusted for inflation says $150 to $200 oil? To this guy, it means nothing. I think if you're looking for $100+ oil prices to justify a home run in low quality, high cost, high beta, I'd say it's more of a speculative gamble than it is an investment. Okay, well, let's tackle this. So he just shows this chart here going sideways. This is what I see when I look at a crude oil, and I'm going to give you a bunch of different charts here. So let's rip this thing unleashed here. So if we go to crude oil, here's crude oil. What do I see here? And what can I use to justify $150, $200 plus oil and choosing some of those high beta, high cost producers? Well, this is what I see. I see a commodity bull market here that occurred under an expansionary phase of real estate. So we're looking at the conditions that crude oil accounts and for the size of the potential move. So what could I use to justify crude oil going to $250 a barrel where this guy cannot see that? Okay, well, I'm just going to do my best, not really to convince anybody. I don't really care if they are convinced or not. That's not the purpose. The purpose is to make a boatload of money. I don't care if I convince you or someone else of this. What I'm telling you is this is what I see, and I see crude oil going to some ridiculous level. So why is that? How do I justify that? All right, let's step through. We've got the CRB to S&P 500. This is from a low state to a high state. That is what occurred last time under an expansionary phase of real estate. Gotcha. Now we're going from a low state that's broken the downtrend line and it's starting to move itself higher. So that's evidence number one. Evidence number one is that the CRB index is starting to outperform the stock index. So commodities are starting to outperform stocks, and we are at a very low level. A lot of the times these move in waves. First wave, pullback, third wave, pullback, fifth wave. It's a three-wave move. Some people also state that this is one wave, pullback, and that we're going to get a monster third wave that's going to blow this one out of the water. Potentially that's the case, potentially it's not. Sure, it's debatable. So in my opinion, wave one has been completed, and we are going to eventually get into wave two, wave three. Wave two is the pullback. Now, is wave two done? We could go down like that. There is a possibility. I'm not stating that I know the exact path of this thing. Maybe we're in wave three. Maybe wave two still needs to correct further. We'll see. But I think that we're at a very low level. And all of these have occurred under expansionary phases of real estate, which we are in. Now, one could state, well, couldn't we go down before hitting the big expansion phase of real estate? That very well could be the case. We could have a recession before the next big move in real estate and credit expansion and the big move in oil and all the other commodities. That very well could be the case. The underlying thing here is that credit expansion is what is causing the moves. Credit expansion occurs when unbuilt homes get built. So what we want to look for is what is the deficit that we have in the housing market, because that is potential credit expansion. And right now we've got the largest imbalance of an undersupplied market in the history of the market. The deficit is estimated somewhere between 3 million homes and 7 million homes, depending on the data that you look at in the source. And there's 4 or 5 different sources that have come up with numbers between those two, 3 million and 7 million. So that is the credit expansion that could potentially come. Why is it not being realized? Well, I don't think it's being realized yet because of the affordability and the interest rates. And there might be a stimulus overhang that is also sprinkled into this mix, which could be an entirely different video in itself. So we're low in the commodity to stock ratio. We've got crude oil. If you were to chart crude oil on a long-term basis, logarithmic wise, let me zoom in here again and blow this up so you guys can see it. So on a logarithmic wise, what you generally want to see is a consolidation that's broken to the upside. Consolidations occur in generally 3 humps. 1, 2, 3, consolidation, false breakout, fling up, breakout of this consolidation pattern to the upside. We've got our back test. Now we could come back and back test again. We could surge from where we're at today. I don't know the path in the short term. Overall, though, what I am seeing is a consolidation that has broken to the upside and a retest move, which is basically cleared for a gigantic move to the upside. So now we're just debating how big of a move could it be. Some things that we can do to evaluate that move is maybe we take last bull market's move, which is this one, overlay it over this because humans are basically trading this all together. And we can get a projection of where this thing could potentially go. This is last bull market overlaid on the current bull market. And I don't know if we're going to come back a little bit more in the short term. Don't know. This would project, if this were to play out on a logarithmic pattern and we were to project it completely the same way, we could get over $1,000 a barrel of oil. And a lot of people are going to say that is absolutely ludicrous. What I'm going to tell them is they have no idea what credit creation is coming. They have no idea what the inflation rate is. They have no idea what any of those things possess. And I don't know if this is going to go that high. Maybe it's a lot less than that. Maybe the pattern is more like this, and it goes to $650 or $500 or wherever it is. I'm not here to try to convince anyone that a commodity bull market is necessarily here. If it's here and it's going to play out, it's going to do it no matter what they think or what I think. It's going to play out no matter who thinks what. In my opinion, given where commodities are at, given what interest rates are doing, and all of those things put together, it's evidence for a potential crude oil massive bull market from an inflationary credit expansion phase. Whether that's driven by fiscal or it's driven by loans in the system against the real estate market, I don't really care which one it's really driving it. I think both of them are going to end up driving it. And I think that's why we get these ludicrous numbers. We can also look at the producer price index. The producer price index, which is PPICO. And then we can divide that by the consumer price index, which is the CPI. Let me just go CPI here. Hold on, guys. Consumer price index for USA. So we've got all these other ones. Let me go down. So here's the producer price index for commodities divided by the consumer price index for commodities. And this is another piece of evidence for crude oil to do some crazy stuff. So what I have here is this ratio. When it goes down, it means that the producer price index is underperforming consumer price index. Basically, it's charting that the world is becoming more efficient and the commodities, in terms of their input prices, are falling in relationship to the consumer price index. What we have is a double bottom here, and this projected double bottom goes all the way back up to 1.17, which is basically back to 1951. This is projecting that the producer price index is going to outpace the consumer price index massively, which means commodities are going to outperform, which means that oil is going to potentially outperform. And one thing you want to notice here is this is the bull market from the 1970s. This bull market is about double the 1970s. So whatever's coming is going to be double the amplification potentially of the 1970s, perhaps, maybe, depending on what could potentially occur. It could be credit creation at the same time that the supply side is choked, which is what we've got in a whole variety of commodities. You could say that's going to occur in oil, copper, uranium, and all of the ones that are our favorites in terms of the metals and all that stuff, platinum, silver, etc., etc., etc. That is where we get the imbalance. It's the imbalance of something like that. It could even be the imbalance of artificial intelligence. Artificial intelligence, what that's going to do, and this is me and my interpretation of all this, is artificial intelligence is going to increase the efficiency of basically all of our businesses in the world. Now, when you increase efficiency, all that is doing is going to increase the intensity of commodities coming out of the ground as fast as we can produce them. Now, if there's a supply constraint in the commodity itself, what's going to happen to the price? Well, the price is going to have to go up dramatically. I don't know if artificial intelligence can increase the efficiency in terms of energy it takes to get something out of the ground. There's going to be a minimal amount of energy to get a commodity that's underneath in low, scarce quantities of low ore grades to get that out of the ground. It's going to require some amount of energy. You're going to have to move material to get scarcer and scarcer materials. Now, I don't doubt that there won't be efficiencies gained in doing that. I don't doubt that they're going to find more in the world, but I don't think they're going to find the massive, gigantic deposits that maybe we have seen historically. So I still think that there's going to be constraints in terms of demand, or not demand, but constraints of getting this stuff out of the ground in low ore grades. And AI, what it's going to do is it's going to increase the intensity of the demand for materials and energy, because all of the materials in the ground is just a derivative of energy. And that there could increase the inflation. So the gaining efficiency on your companies could lead to more inflation, which means that all the companies become ultra efficient, and then they transfer all of the inefficiencies or all of the choke point upstream, which means we could get choked from the commodities point, because now all the companies basically have infinite designs with infinite capabilities to design things quickly. Now your constraint is your actual resources. So all of the wealth isn't in the design, it's in the actual materials to build all of it. And maybe that's the driver. I don't know. But this is signaling that we've got a large commodity move ahead of us with the PPI to CPI ratio. And every time we've had this ratio go up, we've had gigantic commodity bull markets. So this is another piece of evidence to show that. Now, I could also go over other ratios that are also going to support a lot of this stuff. So here's another ratio, gold to M2 money supply is breaking out. This is a big commodity bull market. So this is a big commodity bull market here, and when this ratio is broken out, which it has, this will be another big commodity bull market. So gold to M2 money supply is also showing a bullishness. You can see I've got the ideal double bottom there, double bottom that we're putting in. We can also look at crude oil in relationship to gold. So when we look at crude oil was in a bull market against gold here. This was the pullback in the consolidation from here to here. We've broken that consolidation, and now we're free to roam higher, where crude oil could go ballistic against gold. And if you're using gold as a measuring stick, and if gold moves higher, we're going to be outperforming gold as it goes on up. The ratio, if it were to reach the top here, about 0.15, if it were to repeat and hit 0.15 again against gold, well, gold's at 2,000. I'm just going to use 2,000 as a number. That's oil at 300. So that's another form or indication that crude oil could go to 300 over a longer period of time. I'm not stating that this is going to occur in a millisecond. I'm just saying it's going to take some time over the next decade. Crude oil versus palladium, obviously an outperformance. And then we can go through all those different ratios, and it's all positive for crude oil in an outperformance. Here's crude oil versus silver, pretty stable. Crude oil versus the S&P 500, another one that looks like we could outperform. It's very low. Crude oil versus platinum, I'd say platinum's pretty cheap. But yeah, we can look at all those, and it's just more evidence of crude oil outperforming. So really the main drivers here of why I think oil is going to go above $150, $200 or whatever he said is we're coming into an era where hard assets are going to outperform financial assets. That hasn't happened in over 40 years. All the money's piled over there. It's going to rotate back into hard assets, and it's going to take some time. It's not going to be quick. We have evidence of that occurring and likely to occur over time. And we can even look at the producer price index in relationship to the S&P 500. So let me pull this one up. Let me get this here, and we'll put the S&P 500 in here. And this here, let me reverse this here. So we'll put SPX first. 1 second, guys. So here's the S&P 500. I'm going to put on logarithmic. These are the times where commodities outperformed, are these consolidations. And we've got another form of consolidation that's occurring here. Now, could this go up? Yeah, it could, but I think we're going to consolidate sideways, much like these other time frames here, which were all in a credit expansionary phase of an expansion phase of real estate for every single one. And we've already just started that expansionary phase. We could have a little bit of a pullback. I get it. But we have the undersupply there and the conditions for that to occur again. So I think we've got all the data that's aligned for that to occur. And that's where the money's made. You make money by seeing something and by using the data behind it that other people can't see. That's how you make money. And you have to be early. You have to be before all of those other people. So that's my data that I use there. So uranium is visibly leaving the stealth stage of cyclical markets. Oh, here's another thing. Here's more evidence. Commodities are all putting in basing patterns. That's more and further evidence of all of this occurring. It's not just, the CRB index outperforming financial assets. It's not that financial assets are starting to go sideways. We've got interest rates breaking their 40-year downtrend as well, and interest rates is another driver of rotation of money. There's so much evidence here. You basically, the way that I would view it is if someone has that viewpoint, they basically have not studied the markets in depth, at least. That's my opinion. And anyone who studied the markets, they're going to be long energy, in my opinion, for the most part. Next up, the wall of worry stage. When every article like this gets wise guys on Twitter saying the market has peaked, I expect high volatility going forward, but I'm convinced we're far from a top. A blistering bull run is underway in the market for uranium. AI stocks have hot. Yeah. So again, I think that we are at the beginning of this stage, and I don't think people understand the gravity of how much money needs to rotate into commodities for this market to balance itself out. Now, I'm not stating that has to occur immediately. It's going to take a decade, and you're going to have to use that time frame to your advantage. So when you get market pullbacks, it's accumulate the dips and hold the rips in a big bull market for commodities. That's the way you have to view it. I do think that there is the potential that we could get a slowdown in the market and that we could go lower in the short term if there is some sort of problem in the market, whether that's a banking crisis, whether that's something that goes bankrupt because of the higher interest rates, or something that has to get flushed out of the system from higher rates. Because we've had low rates for a long time, and that's going to have to, when rates go up, they're going to flush some crap out of the system, and that very well could happen. Are you an introvert or an extrovert? I am an introvert. I am definitely not an extrovert. If people were to answer that for for me, they would all call me introverts. I'm not the center of the party. I'm the guy that kind of sits quietly and doesn't interact with as many people. I'll interact with people, but I got to talk about something that I'm interested in. Ideas, topics, sectors, something that I like. If I don't like something and it's just small talk, I really don't like that. If it's, for an hour of small talk, I just can't do it. I can, but it's rough. The interest on the national debt is a bigger deal than most people think. Over 1 trillion now, doubled in the last 19 months. 14% of total spending, 23% of total tax revenue, 58% of deficit. And this is going to continue to balloon. It's growing rapidly. How do you protect yourself against growing credit? Remember, I just showed you all that evidence of crude oil going way up, of the PPI outperforming the CPI, et cetera, et cetera, et cetera. So what does that mean? Well, this could be a tailwind for all of that to occur. That's how this is all kind of interconnected. The debt can get out of control, and the government spending could get out of control. And in all honesty, guys, the value of everything is derived by two things. It's derived by natural resources, which provides the building blocks for a design. And then the design and the manufacturing capability is the other portion of it. So the design and manufacturing of that product is the other portion of wealth. So it's the commodities that build those designs and products, and it's the machinery and the design itself that is valuable. That's the only two things. That's what creates wealth. And if there's an imbalance there between your debt and the wealth creation, then you're going to get potentially high rates of inflation. And if they continue to print money, if they continue to run deficits, that is going to be seen as inflation, in my opinion. What amount of money per month will you be satisfied with? I would say enough money that covers my basic needs plus some amount for, we'll call it, I don't know how you pronounce it, leisure or leisure, depending on where you're from, but some good percentage to do whatever I want for fun. That's what I would say. Maybe that's 10,000 a month. Maybe it's something on that line. That would definitely be probably enough. So maybe $120,000 a year or $10,000 a month that you are able to spend in whatever way that you feel free to. That would include your mortgage, if you have a mortgage. That would include your all of your eating expenses and whatnot. But remember, I've got a family. We have a pretty large grocery bill. Sometimes we get some health bills put in there because one of my kids, he's got asthma, and there's things that I spend on. So that's why I chose about 10 grand a month. It's from the groceries. That's for a family of 5 and some of their health issues, because I had twins and they were premature kids, and they do have some breathing problems every once in a while. They need like some medicine for their breathing. One of them has asthma. Coming on in, Bloomberg, Saudi Arabia's energy minister has just said speculators are the problem, not demand, in terms of the recent oil fall. It's not weak, says Salman. People are pretending it's weak. It's all a ploy. And I don't know. We'll see. I think it's probably just a pattern playing out. and eventually will eventually rip to the upside. Maybe there is a slowdown in the market and it hasn't impacted demand yet. People are trying to project further than what is being printed today. I don't know, but we'll see. It'll work its way out and it will be positive over the longer term, I think. Game of Trade says, the yield curve has been steepening aggressively from inverted levels. This development systematically occurs near sharp economic downturns. Now, what you want to understand is what causes the yield curve to invert and what causes it to uninvert. Well, it causes it to invert because generally you get into an inflationary period. When you get inflation, the yield curve inverts, which means the shorter end of the curve, which is more sensitive to inflation than the longer end, moves up at a faster pace. So the yield curve inverts. And what this is signaling is where you are in the business cycle. Now, the difficult part is we are massively underbuilt. What that means is the homes that are not built are credit creation, future credit creation. It's future inflation, basically. We're also going to see a velocity of money probably kick up as the millennials come into higher peak spending years and having kids and all that other stuff. We also don't know that this could easily come back down and do like a big double bottom. It could do a shoulder here, and then maybe we put a head and another shoulder. You can see here that this was coming back up in the late 70s. We saw another one that was coming back up here in the mid 70s. So we could bounce around for a year or two before this actually uninverts. A lot of people are calling for a recession. I know the recession isn't going to come from the housing market. It would be driven by some crap coming out of the system due to an increase of interest rates. Now, interest rates might be at too high of a level because it's the credit that was created at the beginning of this boom was real estate market plus stimulus. Now, the inflation is the component of those two. And when you add it up, it might have increased interest rates to a level that's not sustainable by the real estate market. So we could get a slowdown, the interest rates pull on back, and then the real estate market really takes off. That could be a potential outcome. Or the interest rates are at the level and the housing market still continues to boom, which is also a potential outcome. I don't know which outcome is necessarily correct, but they're both outcomes that I think will eventually occur, which means that the real estate market will build those homes eventually, and it will be inflationary at some point. QE Infinity says, this is what needs to happen to fix things according to one of the best models out there. Taxes have to go up by 40% or spending has to drop by 30%. If this isn't addressed, the bond market will have a fit. QE isn't coming back, folks. Higher rates are here to stay. And that's solving the deficit. We need a 40% increase in taxes now and forever, or a 30% or a 30% decrease in spending now and forever, or the combination somewhere in between those two. That is what's needed to basically abate this problem. Is it worth it to drive an hour one way for a $100,000 per year job? Okay, so I actually was confronted with this. So I applied for a job that was about 60 miles away, and it's about an hour drive. The price difference between what I was making here versus Denver, because it was up in Denver, I live in Colorado Springs, the price difference was about $30,000, $30,000 to $35,000, and probably a little bit more upside potential than the company that I was working at in Colorado Springs. And I got offered the position. They made that offer, and I could even negotiate my vacation. But I was when I first applied, I was under the impression that I could work from home for 3 to 4 out of the 5 days. But that changed as I was negotiating with them. They said, nope, you got to come back in 5 days a week, et cetera, et cetera. So this was a 5-day-a-week position where I had to go every single day, drive an hour there and an hour back. And really the delta there is about $30,000 to $35,000. Now, is it worth it to do that on a top line level of $35,000? There would be some things I would have to give up if I were to give up 2 hours a day. Now I have my YouTube channel. I've got the website. I've got other things that I have going on outside of work. I was not happy with where I was at. And this here could be a potential way to do something that's different. And what I kind of realized, $35,000 and really 2 hours a day. So really, I'd have to get paid 2 hours. It'd have to cover the gas. It would have to cover the vehicle that I'm basically destroying. I'd have to. They didn't have parking at that place. I had to actually take the light rail in, which makes it even worse and longer. So now you're talking maybe an hour and a half. So 3 hours per day of travel. So that's 3 hours per day that I would have to also get compensated for out of that $35,000. So what I did is I kind of said, you know what? Let's just calculate this out. If I go up there for, let's say, 45 weeks times 5, about 225 days out of the year. Then you multiply by 3 hours. That's an extra 675 hours. I did 35,000 divided by 370 hours? Oh gosh, can't even think about it. 225 times 8. Hold on. It's 225 times 3, 675. 675. So divided by 675, that's getting paid $51 for my travel if I were to do that. And what I did and what I thought was I declined the position because I would also probably end up not liking traveling, so I'd have to move up there. But then I'd also have to incur moving costs and all these other things. And I'm like, what is this worth it? Is it really worth it? I can't pick my kids up at school. I can't do half that crap. If I forget something, I am screwed. I didn't do it. I decided it was not worth it for a $35,000 delta in pay. Now, what would make it worth it? I would think $100,000 on top of what I was making would probably be worth it. I would probably say 75,000 would probably be worth it. 50,000, I doubt it's worth $50,000 a year delta. That would be getting really close to the break-even point. So for me, going to a place 1 hour away where I could move there eventually, I think 50 grand a year would probably be the break-even area, somewhere in that range. But that also means that I would not give up certain other things of my life to do it. Because they also put in there that I said, could I come in early and leave early to avoid traffic? And they said, no. You need to be there at around 7 a.m. and stay till 5 p.m. I'm like, no, there's no way that I'm going to be driving in during traffic and leaving during traffic and spending that amount of time. You're basically killing my dollars per hour. I'm like, no, give me like 200,000. I'll think about it. Of course, they're not going to do that. But I mean, that's just, no, it's not going to occur. So I didn't do that. And as time goes on, this number continues to go way higher for me because as you get wealthier, the convenience factor goes up and up and up and up. If something's inconvenient and you've got money, why do it? Why the heck do it? That's the whole reason I saved all my freaking, 20s and 30s and investing and all that stuff. That's the whole reason I did it. So I can say, F you, I'm not going to take it. And I don't need to be inconvenienced in such a way where if I don't have to. What makes somebody trustworthy? Repeatable actions is what makes someone trustworthy. So if they say they're going to do something and they repeatedly say what they're going to do, makes someone trustworthy. What makes someone not trustworthy is when they say they're going to do something and they do something completely the opposite. Then that makes them deceitful and not trustworthy, that's for sure. JPM on global oil demand. The oil demand tracker, global oil demand expanded 2 million barrels per day year to date through November 7th, Regional data remains mixed. So big move in global oil demand. 2 million barrels a day year to date. That's huge. Eric says it's not weak. People are pretending it's weak. It's all a ploy. We strongly believe the sharp sell-off in oil has been driven by a meaningful liquidation and speculative length rather than a sudden sharp deterioration in fundamentals. Collapse in financial oil demand, while physical oil demand has remained strong enough, inventories remain at multi-year low levels, and we see them headed lower still, even with a possible recession in 2024. Daily global gasoline and diesel demand measured to 2019 baseline. Look at this, guys. Look at this recent move upward in gasoline and diesel demand. That's crazy. Another thing that you could almost state is, are we trying to hold the price of oil down? Because look at the demand increase here since the beginning of the summer. I mean, this is crazy. Absolutely crazy in terms of that global gasoline and diesel demand. Holger says, over the last 120 years, 98% of all countries where sovereign debt hit 30% ended up. I covered that one last time. So we're going to end it there. If you guys like this content, give me a thumb up. Subscribe to the channel. Subscribe to the website. Discounts, coupon code. We've got a 7 a.m. Mountain Standard Time on Saturday question and answer session for the members. You can come and ask me questions directly. I am going to talk a little bit perhaps about the setup and how the cycle works. And why this cycle might be a little bit different than some of the other cycles. So that's something I might talk back and forth with everyone in the beginning of the session is this is what I see. I'll even draw it out, and you guys can get a better understanding of that. All right, guys, that's all I've got. We'll catch you guys next time. This is Finding Value.